Welcome to this month's market update. I'm joined today by KC Lowe, Senior Consultant with Frontier. Hi KC.
Right.
Well, again, lots happening as always. In particular, over the last month, we've just seen bond yields kick up a little, and that seemed to spook equity markets. Can you talk to us about the dynamic at play there?
Yeah, so that's right. We're seeing bond yields increase quite sharply over the month. And the reason why it has spooked equity market is because, well, it links back to equity market valuations. Compared to its own history, it's actually quite high right now. But compared to bond yields, which are at very low levels right now, it's actually looking more fair. So if I put in a simple example, if you're getting 3% in dividend yield from equities compared to 1% from bond yields, then as an investor, your preference would be towards equity stocks. But then if you see bond yields increase to, let's say, 3%, then it becomes less certain which asset class you want to invest in, because you're getting a similar yield from both, but you're taking on a lot more risk by investing in stocks there.
Sure. So turning back to bond markets, can you just drill down a little bit and tell us about what was actually at play there over the last month?
So I think there's three areas to cover here. The first one is on the change itself, the second one on the level, and the last one's on the composition. So in terms of the change, it was a very sharp increase. So the US 10-year government bond yield increased by around 40 basis points, or 0.4%. And then the Australian government 10-year government bond yield increased by around 0.8%. So it's a very large move in what tends to be quite a sleepy part of the financial markets. On the second point of the level, so even though the increase was quite sharp, it is still quite low in terms of historical context. So yes, it's increased a lot, but the US 10-year government bond yield, it's only at 1.5% right now. And then Australian government bond yield is at 1.8%. So still very low levels compared to history. Now the last area to cover is on the composition. So it's important to differentiate between the increase driven by growth expectations versus inflation expectations. Where bond yields are increasing because of inflation expectation, then that is more concerning for markets, because then it means that central banks will have to start to think about increasing interest rates again. But what we're seeing right now is that the sharp increase in February was largely driven by growth expectations, which is to be expected at this point in the cycle where the economy is recovering from a big recession. So expectation should be improving right now.
Sure. Now, the Australian dollar, it's been appreciating a little bit of late. What's been driving that added strength?
So there's a few factors there. The two key ones is probably Australia's better economic outcome compared to other countries, particularly due to the better COVID management that we've seen. The other key driver for the Australian dollar has been just commodity prices. It's been increasing, particularly iron ore prices. So we've seen iron ore prices increase to levels we haven't seen since about 2011, so almost a decade ago. And the reason behind that is twofold. The first part is that Chinese demand for iron ore has increased significantly over last year because they've been using infrastructure spending to support their way out of the pandemic-driven recession. The other side has to do with supply constraints. So we've seen supply issues in Brazil, which has limited iron ore going into China. But what we've seen as of late is that, yes, there was a huge increase in infrastructure spending in China, but that has started to slow down. And then on the other side of things, yes, supply in Brazil was hit, but we're seeing it gradually pick up now.
Thanks, KC. Some interesting insights across a number of different areas there. Thanks for joining us, and thanks for watching this month's Market Update.